All right, part two here, and we're going to talk about net operating losses. Corporations, like individuals, could have a real problem with their uh, income and have a net operating loss. In fact, it's probably more likely to happen for corporations. This is a situation where the deductions are higher than their revenues and they have a loss. There is no carry back any more like there used to be for corporations. It is only carry forward. There, so that's important to remember. It only can carry forward. Actually, the rules are simpler than individuals because you don't have personal deductions being deducted that you have to add back to get the NOL. So we file 1120 for corporations. Due date is April 15th for calendar year, 3.5 months after the tax year ends. That is different than it used to be. That was changed a couple of years ago, so that's important to remember. And there's a separate rule. If you're June 30th, you get 2.5 years, 2.5 months. You get a extension, Form 7004, and get more time to file is 6 months. For everybody except for those June 30th, you get 6 months, and June 30th gets 7 months, remember, because they got 2.5 months to start with. So it's like somebody had something out against them or something. There is no graduated tax rate for corporations anymore, or for C corporations, I should say, for 2018. So it is a flat 21%. Doesn't matter whether you make $1 of income or $1 million of income, you pay the same percentage as a corporation under the current tax law. Simple as that. Now, corporations do not get to wait till the due date of their return to make payments on their taxes or to submit their tax payments. They have to make what's called estimated tax payments. Otherwise, they could be charged penalties and interest on the amount that they don't pay. So as the year goes along, they are to estimate how much tax that they are going to owe and pay a portion of that. 25% the 4th month, 25% in the 6th month, 25% in the 9th month, and 25% in the 12th month. So that is what is, if you do that, you will avoid any penalty or interest on that, on underpaying your tax. You can avoid this by paying either the lesser of this year's tax liability, so 25%, 25%, 25% of this year's 20, if you were in 2018 or in 2019, this year, or 100% of the year before liability. So having a hard time estimating based on the current year's income, you can use last year's income. If you have at least $1 million, you can't use last year's. All right, so that means you've got to use this year. You've got to be estimating and pay it. And if you don't pay at least that amount, you're going to be charged penalties and interest on that. Distributions. This is money from a corporation to the shareholders. They are treated differently depending on the situation. So they can be either dividends, which are taxable to the shareholder, tax-free returns of capital, which means that it reduces their basis in the shares but does not go on their tax return, or it could be capital gain, and we know all about capital gains from our earlier discussion as it applies to individuals. So the shareholder is going to be treated as ordinary dividends and gross income, which is the same idea, because ordinary incomes are included in income, as long as it comes from the corporation's earnings and profits. All right, if they pay you more than the earnings and profits, then it's a return of capital. up to the basis of the stock or what they have originally paid for the stock. After that, any distribution is capital gain. Now, earnings and profits is roughly equivalent to retained earnings. It's the money that the corporation has earned from a tax standpoint, but has not distributed earlier in the form of dividends. Okay? Now, what if that distribution is paid with property? First of all, the fair market value of that property. So instead of giving you cash, what if the corporation distributes say a building or inventory or something like that? The distribution is recorded at its fair value. If it's appreciated, meaning the corporation's basis in the building they distribute to you is $60,000, but it's worth $100,000, they must treat it as if they sold it for $100,000, record the gain of $40,000, increase the earnings and profits, then reduce the earnings and profits by the amount of the distribution. And then the shareholder gets the property and their basis is the fair market value at the date distributed. So because you use a fair value to calculate distribution, that also becomes the basis to the shareholder so that they know how to calculate the gain or loss when they turn around and sell that property in the future. So an example. Distribute land worth $20,000, shareholders basis is $4,000, the term of distribution or earnings and profits is $5,000. So what's going to happen? We're going to recognize $16,000 on the distribution, right? So it's worth 20, it was cost us 4, so the gain of 16 is recognized. That increases our earnings and profits from 5 up to 21. That goes into our profits as a corporation. Then the distribution reduces earnings and profits by $20,000. This would all be an ordinary dividend because earnings and profits are 21. If the distribution was more than 21, then it would pay back the basis in the stock to the shareholder. If it's even more than that, it could be capital gain. Distribute land for 10,000 above. Shareholder alpha's basis is 24. Time of distribution, or EMP, is 35. Now this value is less than what the basis is. Okay, no recognized loss on that. Earnings and profits is 35. The amount of distribution is at the fair market value, and $10,000 is ordinary dividend. All right, so the loss on this property is lost, truly lost, because it doesn't benefit anybody. Okay. So that gets us through distributions on to the shareholders in terms of dividends and how that is taxed to the shareholder as well.